It is very common to see a beginner make mistakes due to a lack of experience while being overconfident. Investing in mistakes not only costs you capital, but can also make you feel worthless. And when your wallet and mind are shaken, it leaves probabilities for even costlier mistakes. Yet, when you start investing, there are many common mistakes you'll want to refrain from making as best as you can. It can be a good learning experience, but you still want to end potential defeats that set you back. Even investing experts make mistakes. It's all part of the process. However, to help you on your investment journey, we're going to be sharing with you the top common investing mistakes most beginners make and should steer clear from. 1. Timing the market. Timing the market can be a tempting strategy, but it is generally considered to be a risky approach to investing. There are many reasons why you should be cautious about trying to time the market. It is difficult to predict market movements. Even the most experienced investors struggle to predict market movements with consistency. Many factors can influence the stock market, including economic indicators, geopolitical events, and company performance. Attempting to time the market requires accurately predicting these variables, which is extremely difficult to do. You may miss out on gains. If you try to time the market and get it wrong, you risk missing out on gains. Market movements can be sudden and unexpected, and if you're not invested during a period of growth, you may miss out on the potential for returns. It can lead to impulsive decision-making. Attempting to time the market can lead to emotional decision-making, which can result in poor investment choices. Investors who try to time the market may be more likely to buy and sell assets based on short-term market fluctuations rather than long-term trends. Timing the market is more important than timing the market. Timing the market is generally considered to be more important than timing the market. Studies have shown that investors who stay invested over the long term tend to outperform those who try to time the market. Timing the market is generally considered to be a risky strategy. It is difficult to predict market movements, and attempting to time the market can lead to emotional decision-making and cause you to miss out gains. Instead of trying to time the market, it is generally recommended to stay invested over the long term and focus on a diversified portfolio that aligns with your investment goals and risk tolerance. 2. Investing without a goal. Investing in the stock market without a goal can be risky and may not yield the desired results. Here are a few reasons why you should invest in the stock market without a goal. Lack of clarity. Without a goal, you may lack clarity on what you want to achieve with your investment. You may not know how much money you need, what your investment timeline is, or what level of risk you're willing to take. No plan. Without a plan, you may make hasty investment decisions that are not in line with your financial situations, goals, and risk tolerance. You may also fail to diversify your portfolio, which could leave you vulnerable to market fluctuations. Emotional investing. Investing without a goal could lead to emotional investing. You may be tempted to buy or sell stocks based on market sentiment or news, which could result in impulsive decisions that do not align with your long-term goals. Lack of discipline. Investing without a goal could also result in a lack of discipline. You may be more likely to abandon your investments during market downturns or sell when the market is high, which could lead to missed opportunities for growth. In conclusion, investing without a goal is risky and could lead to poor decision-making, emotional investing, and a lack of discipline. Setting clear goals and developing a plan can help you make informed investment decisions and increase your chances of achieving your long-term financial objectives. 3. Only deciding by impulse. Investing using only emotions can be risky and may result in poor investment decisions. You need to understand some of the reasons why you should never invest in the stock market using only emotion. Emotional investing can lead to impulsive decisions. When investing based on emotions, you may be more likely to make hasty decisions that are not grounded in fundamental analysis or smart investment strategies. This could end up in buying or selling stocks at the wrong time, which could lead to losses. Impulse can cloud your judgment. Emotions can cloud your judgment, making it difficult to make rational decisions. For example, you may hold on to a losing stock for too long because you're hoping it will recover, or sell a profitable stock too soon because you're afraid of losing your gains. It can lead to false positives and overconfidence. When you experience success in the stock market due to a lucky streak, it is easy to become overconfident and assume that you can keep winning. This can lead to taking on too much risk or investing in stocks that aren't a good fit for your investment goals. Impulse can make you miss opportunities. Emotions can cause you to miss out on good investment opportunities. For example, you may avoid investing in a stock because you don't like the company, even though it has a strong financial track record and growth potential. In the gist of it, Investing in the stock market using only emotion can lead to impulsive decisions, clouded judgment, overconfidence, and missed opportunities. It is important to use a combination of fundamental analysis, sound investment strategies, and a rational mindset when making investment decisions. 4. Not diversifying your investments. Diversification is crucial to investing because it helps to reduce risk and improve long-term returns. There are many reasons why you should diversify your investments. It reduces your risk of loss. Diversifying your investments across different asset classes, industries, and geographic regions can help to reduce your overall investment risk. If you only invest in one stock or one industry, you are exposed to the risks associated with that specific company or industry. However, by diversifying your portfolio, you can spread out your risk and protect yourself against potential losses. Diversification maximizes returns. Diversification can also help to maximize your returns. By investing in a variety of asset classes and sectors, you can take advantage of opportunities for growth in different parts of the market. This can help to offset losses in other areas and improve your overall investment performance. It provides flexibility to work. Diversification also provides flexibility in your investment strategy. By investing in a range of assets, you can adjust your portfolio based on market conditions and your changing investment goals. Somehow, it also helps manage your emotions, especially during market downturns. If you have all your money invested in one stock or asset, you may be more likely to panic and sell at a loss during a market correction. However, if you have a diversified portfolio, you're more likely to weather the storm and stay invested for the long term. 5. Gambling rather than investing. Investing and gambling are very different from each other with different goals and outcomes. While both involve taking risks, there are some reasons why investing is generally considered a better choice than gambling. Investment is based on analysis and research. Investing typically involves conducting research, analyzing financial statements, and considering economic factors before making a decision. This helps identify potential opportunities and minimize risks. In contrast, gambling is based on chance and the outcome is unpredictable. Investments generate returns over time. When you invest, you are buying an asset with the expectation that it will appreciate over time and generate returns in the form of dividends, interest, or capital gains. While the returns may not be immediate, investments can provide steady income and long-term growth. In contrast, gambling is typically a short-term activity with no expectation of generating returns over time. Investment is part of a long-term financial plan. It becomes a key part of a long-term financial plan, helping to build wealth and secure financial futures. On the other hand, gambling is often a recreational activity that does not contribute to long-term financial goals. Investing also helps promote diversification. It allows for diversification across different asset classes, industries, and geographic regions, reducing the risk of losing all your money in a single investment. In contrast, gambling is typically a binary activity where you either win or lose. In the long term, investing is generally considered to be a better choice than gambling because it is based on analysis and research, generates returns over time, is part of a long-term financial plan, and offers diversification. While both activities involve taking risks, investing is a more strategic and thoughtful approach to growing your wealth and securing your financial future. 6. Running after returns. Running after high returns when investing can be tempting, but it can also be a risky strategy. Here are some reasons why you should be cautious about chasing returns. High returns often come with high risk. Investments that offer high returns come with a higher level of risk. This means there is a greater chance of losing your money, particularly in the short term. High returns may not be sustainable. Investments that offer high returns may be unable to maintain that level of performance over the long term. It is vital to evaluate the underlying fundamentals of an investment, such as the company's financial health, market conditions, and other factors that could affect performance. Chasing returns can lead to impulsive decisions. When you focus too much on returns, you may be intrigued to make impulsive decisions based on short-term market fluctuations. This can lead to buying or selling stocks at the wrong time, which results in losses. It is crucial to focus on your investment goals. Investing should be based on your investment goals, time horizon, and risk tolerance, rather than solely on the potential for high returns. It is important to have a diversified portfolio that aligns with your goals and balances risk and reward. While the potential for high returns can be appealing, be cautious about chasing returns when investing. High returns often come with high risk and may not be sustainable and can lead to impulsive decisions. Instead, Focus on your investment goals and invest in a diversified portfolio that aligns with your long-term financial objectives. 7. Not having credible sources for information. Having credible sources of information is crucial when investing because the decisions you make can significantly impact your financial future. Here are some reasons why you should rely on credible sources of information when making investment decisions. Helps you make better decisions. Credible sources of information can help you make informed decisions when investing. They can provide you with valuable insights into market trends, company performance, and economic indicators that can help you make sound investment decisions. Reduces the risk of making bad investments. Relying on credible sources of information can reduce the risk of making bad investments. By doing your research and evaluating information from reputable sources, you can identify potential risks and make more informed decisions about where to invest your money. Protect against fraud. There are many investment scams and fraudulent schemes out there, and relying on credible sources of information can help protect you from falling victim to these scams. Invest in assets confirmed by reliable sources so you can reduce the risk of losing your money to frauds. Provides greater confidence. Having access to credible sources of information can provide you with greater confidence in your investment decisions. When you have done your due diligence and made informed choices, you can feel more secure in your financial future. In summary, having credible sources of information is essential when investing. It can help you make informed decisions, reduce the risk of making bad investments, protect against fraud, and provide greater confidence in your investment choices. By researching and relying on reputable sources, you can increase your chances of achieving long-term financial success. Avoid these mistakes so you can change your life one day. Become the investor you dreamed of becoming. Let us know what you think in the comments. Thanks for watching, and don't forget to like and subscribe for more financial tips and advice.